In the previous video, we looked at current assets. In this video, we will look at the second type of assets, the fixed assets. Fixed assets are those assets which have a useful life exceeding 1 year, as opposed to current assets which have a useful life less than a year, or which can be converted into cash within a year. So what are those assets which have a useful life exceeding 1 year? There are two major types of fixed assets. The first one is physical or tangible assets. Example, office buildings, plant and equipment. The second one is less tangible, but they are long-term assets. Example, patents, trademarks, copyrights. So let me explain what patents and trademarks are. Patents and trademarks are types of intellectual property. What is this intellectual property? Intellectual property is something that is created by the mind. What does your mind create? Ideas. But intellectual property does not protect bare ideas. Rather, it is the expression or symbolic power or recognizability of the ideas that are protected. Confusing, isn't it? Let me explain with an example. The design of a rocket can be patented, but not the idea of a rocket. Similarly, the painting of a lake can be copyrighted, not the idea of a lake. The consumer recognizable logo, that is trademark, not the idea of a logo. So, these patents, trademarks, copyrights, etc. are intellectual property, and they protect how we express and identify ideas in concrete ways. Not the idea itself. It's the expression of these ideas. Now, these patents, trademarks, and copyrights have fair market value, and if somebody wants to use the intellectual property rights of a company, that somebody has to pay a royalty or fee to the company for an agreed period of time for right of use of that idea. Just like how if you want to rent a house or an apartment, you have to pay a rent to the house owner or the apartment owner for right of use of the apartment for the time that you're using it. Similarly, even for intellectual property rights, the owner of these rights shows these rights as long-term assets in the balance sheet because they have exclusive right of use to these assets, unless you pay royalty or fee to use them. So now do you understand why these are assets? Good. Now, while fixed assets have a useful life exceeding 1 year, we pay the entire cost of the fixed assets at the time of acquiring the fixed assets. But the monetary value of an asset decreases over a period of time. So why does the monetary value of an asset decrease over a period of time? It's because of usage, passage of time, wear and tear, technological outdating, which is otherwise called obsolescence, depletion, inadequacy, decay, or such other factors. This decrease is measured as depreciation. Depreciation is a decrease in an asset's value, and it may be caused by a number of other factors as well, such as unfavorable market conditions, etc. So, machinery, equipment, currency are some examples of assets that are likely to depreciate over a specific period of time. Accounting estimates the decrease in value using the information regarding the useful life of the assets. So, how does accounting estimate this? Let's look at an example. If an office building was purchased for $25 million and the useful life of this building is 25 years, we reduce the value of the building every year by $1 million. 1 million for each of the 25 years, right? So this $1 million is called depreciation. And the opposite of depreciation is appreciation, which is increase in the value of an asset over a period of time. So, to sum up what we have learned so far, the asset side of the balance sheet shows what the business owns, and the asset types are current assets. Types of current assets are cash and cash equivalents, accounts receivable, inventory, loans and advances. Then fixed assets at historical cost and accumulated depreciation. Now let's look at some numbers. Cox and Wheels is in the business of sale of car tires as on 31st December 2015. Cox and Wheels had a bank balance of $15,000. Some customers who had bought tires on credit had not yet paid up for their tires, and their credit amounted to $3,000. Cox and Wheels had an inventory of $5,000 of tires as on 31st December. The manager of the tire store had taken an advance of $2,000 for Christmas and promised to repay this advance after the New Year's. The company had a warehouse and sales office in the same place, which was purchased in 2010 for $500,000. This office was depreciated by $20,000 every year. So now, what does the asset side of the Cox and Wheels balance sheet look like? If you go back, you can see Cox and Wheels had a bank balance of $15,000. So you can see that 15,000 here under current assets. Then it had some customers who had bought tires on credit for $3,000. You can see those $3,000 as accounts receivables here. Now you can also see that Cox and Wheels had an inventory of $5,000 and the manager had taken an advance of $2,000, which he was going to pay within 1 year. So you have the inventory of 5,000 and loans and advances of 2,000. Add all this, what do you get? Current assets, total current assets of $25,000. 15 plus 3 plus 5 plus 2, which gives you $25,000. Then you can see that the company had purchased a warehouse and sales office for $500,000 in 2010, and the company has been depreciating this asset every year for $20,000. And we are preparing the balance sheet, asset side of the balance sheet as of 31st December 2015. So from 2010 to 2015, the asset has been used for 6 years. So the depreciation is 20,000 times 6. Total accumulated depreciation is 120,000. And the cost of the asset is 500,000. So the net fixed asset is 380. That's 500 minus 120. That's 380. So now the total assets are 380 plus $25,000, which amounts to $405,000. I know you have learned a lot of new terms in this video. Go over the video a few times, pause the video, take notes, and go over it again till you're comfortable. Also note that I have not defined a term which I have used in this video. What term is that? Find it out and Google it. When we meet next, we will talk about it. In the next video, we will look at types of liabilities. With that, you should be done with the balance sheet concepts.